In terms of how we invest your money, I guess we would say that we start from a slightly different perspective to a lot of other fund managers. Consensus in this industry is that you start off by saying that investments equal equities. But for us, however, there's an extra layer of engaging the brain before investing in the stock market. So we receive your money, and the first thing we do is to ask ourselves which asset classes look attractive, but also which asset classes do we think look unattractive. And if we think that an asset class or an investment strategy looks attractive on a risk-adjusted basis, then we will happily apportion some of your capital there. But conversely, if we think that some investment strategies look unattractive at any given point in time, for example, UK government bonds at the moment, then we simply won't put any of your money there. Now, in fund management speak, this is what's known as multi-asset class investing. It's nothing new if you're a family office or institution or a private bank. If you're the Rockefellers or the Carnegies, you've been investing this way for over 100 years. But it is slightly different to the way that money has traditionally been invested for people like you and me on the high street. The main reason we invest this way is simply because it works the best. The slide you can see now shows how our low-risk portfolio has performed since we first started Saltus. If you look at the box on the bottom right, the thick red line shows the performance of the Saltus low-risk portfolio after fees and costs. And as you can see, it's pretty much done what it says on the tin, despite the credit crisis. The thin red line shows how the stock market performed over the same period. The purple line shows how traditional private client portfolios performed, and the green line shows cash. The box on the top left shows the same data set but asks a slightly different question. And the question is, how much risk was taken for the returns generated? So the vertical line on the top left shows the compound rate of growth of the portfolio over the same 7-year period, and the horizontal line shows how much risk was taken. Now, the industry jargon for this is called the volatility of the portfolio. The thick red dot you can see is Saltus, and after fees and costs, we compounded wealth at 5 and change, which was about twice as much as the stock market over the same period. But we did this while taking only a third of the risk of the stock market. Or, using the same data set a different way, we handsomely beat the cash dot whilst not taking much more risk than cash. I think Saltus is more like the tortoise than the hare. Very dependable, very steady. And we're proud of that because that's exactly what our clients expect of us.